One of our clients sent us an email over the weekend and it had just one word in it. Ouch. That pretty well sums up what happened in April. April, it's usually the best month of the year, was actually the worst month we've had in a long time. Now, I'm Steve Wolf and I'm giving you a recap of what happened in April. But before I do that, let me just get to the disclaimer real quick. What I'm about to say is strictly for informational purposes only, and it's not meant to be a recommendation. So before you go out and buy or sell anything relating to anything I'm saying about the markets or individual securities, be sure to consult your financial advisor to ensure it's the best recommendation for your personal situation. Now let's see what happened in April. Well, the Dow Jones was down 4.9% in the month. The S&P was down 8.8% in the month, and the NASDAQ just got walloped. It was down 13.3% in the month. That 13.3% was the worst performance since October of 2008 when our banks were failing. So it was really a bad month. And by the way, the Dow and the S&P's performance, that was the worst since March of 2020 when the pandemic started. Now, as many of you know, I run 3 different stock portfolios. One portfolio I run is a dividend income portfolio with high quality dividend type stocks. A second portfolio is a growth portfolio, kind of the bigger ones. And then the third portfolio is something we call our caveman portfolio, which is a pretty aggressive growth stock portfolio. I can tell you that this down market hit the aggressive stocks first. The small ones that were aggressive, they've been hit. They started going down back in the middle of November. Then it rolled over into the mid-sized stocks, and that hit the other growth portfolio that I run. And finally, it started hitting the big growth stocks, the FANG stocks, the Facebooks, Apples, or Meta now, I guess, the Amazons, etc. And I can tell you that the NASDAQ is down about 23% for the year, and that puts it firmly into the bear market territory. The other two are still in correction territory. They're not quite near there yet, but they're down too. So everything was down in the month, including bonds. The bond market is getting hit because interest rates are going up. As interest rates go up, the price of bonds goes down. So a couple of things that you should know is happening right now. The percentage of bullish investors currently is down to 16.6%, according to a company called Wide Charts. Now that's down about 69% from where it was just a year ago. And it's the highest level of pessimism that we've seen since March of 2009. Now, this is from the American Association of Individual Investors at the end of April. It said this week's bearish sentiment reading ranks among the 10th highest in the history of the survey. That's bearish. That means people are very down on the market. And it said this week's bull-bear spread, or the difference between people who think that things are bullish right now and people who think that things are bearish right now, is at 42.9%. And that is the 6th most negative it has ever been. Historically, the S&P 500 index has gone on to realize above average and above median returns during the 6 and 12-month periods following these unusually low readings for bullish sentiment and for the bull-bear spread, according to the American Association of Individual Investors. Now, interestingly, the survey said that we were 16.4% bullish, 24.2% neutral, and 59.4% bearish. Now, that bearish sentiment is up 15.5 points in just a week. That's the last week of April. Historical averages, just to put it in context, is that the bullish percentage is usually about 38% versus 16.4% it is now. Neutral is usually about 31.5 versus about 24.2 now. And bearish usually is around 30.5, and it's almost twice that at 59.4%. Now, we all know the reasons that this is happening. I mean, we've talked about them a lot. I'm sure you've read about them a lot. There's inflation. There's the rising interest rates. There's a supply chain, which is causing a big issue. It's clogged up. We can't get parts. I know I'm still waiting for furniture that I ordered back in September, and here we are in the beginning of May. The war in Ukraine is hurting things. The price of wheat and corn has gone up because a lot of that comes from the Ukraine. Oil is up. China has shut down its economy. It's really shut down its whole society because they're trying to get COVID to zero. Don't know if they can ever do that, but that's what they're trying to do, and that's hurt the world's economy. And now there's one more thing that just happened, and that's our gross domestic product, or GDP, was down by about 1.4%, and that's down for the first time in quite a while. Now, who knows? This might turn around because there were a lot of imports in the last month, and we think that will turn around, especially if Germany says no to Russian oil, and then we start exporting oil, natural gas, etc. So I have a feeling that may be short-lived, but in the meantime, it's an issue. Now, the PE, the price to earnings ratio on the S&P 500 at the end of March was 21.92. Now, I couldn't find the current PE of where we are exactly at this date, but considering the rout in the marketplace, I'm sure that it's under 20, probably closer to 19 or 18. We'll try to get that just as soon as we can. Probably we'll have it in the next few days. Historically, the S&P has spent about 65 to 75% of its time between a PE of 12 and 20. And this is according to an article by a company by the name of Finasco. Now, if you consider that 16 then would be about the average for the S&P 500, that would be what we just said is about one standard deviation from average. Now, the market has spent, the S&P, 95% of its time at least between two standard deviations from the mean. That translates to a PE ratio on the low end of between 7 and 12, and on the high end, it's a ratio of 20 to 27. So between 7 and 27, that's two standard deviations. But just a few short months ago, the PE was around 38. Now that's 3 standard deviations away from the mean. Now the S&P has only spent about 2.5% of its time in history at that type of a rate. We're either 2.5% on the upper side, 2.5% on the lower side. So that is most unusual and extremely, extremely negative. Now look, I know it's hard to be positive when it looks like everything around you is falling apart. But I'm going to give you a little something positive to think about. When sentiment gets this bad, it's usually followed by an upturn in the market. So maybe being this bad is good. I don't know. There are some stocks that I believe are getting just really undervalued right now and really represent some excellent buying opportunities. Now, there are many indicators I've seen over the years to try to give us some idea of where we are in the market. One of the newer ones, an indicator that at least I've never heard of it before, it's called the fluffy puppy indicator. Now, what is that? The theory is that when people are not buying those little extra things for their dogs and their prize pooches, well, that usually means we're in a slowdown in the economy. So, yeah, that fluffy puppy one is one. It's new to me, but who knows? Maybe there's some accuracy to it. But I usually go by the gut check indicator to see if we're near a bottom or not. My gut check indicator is that when things get so bad in the marketplace that you just feel like you're going to throw up. And it's not only a sign we're bottoming, but it's a sign that we need to be looking to buy things that have gotten so far undervalued. Remember that in hindsight, stocks like Apple and Amazon and Tesla, they all had their negative moments when they were really undervalued. And anyone who had the guts and the foresight to buy them and hold on made a ton of money. Now, I don't know if that's going to happen this time, but again, this is what's happened in the past. And of course, we always say that past performance is no guarantee of future performance, but still, it could give you an indication. Now, we might very well be in that position now, or perhaps in the very near future, to start picking up some companies that years from now, you'll be glad you did. Things still might get worse from here before they get better, but I think the risk-reward has definitely changed a lot since just a few months ago. So that's the story for April 2022. I'll be back next month to recap what happened in May. Until then, happy investing, everyone.